Welcome to Magic Minutes by MGIC, mortgage industry training that helps you expand your knowledge and skills. Before we get started, take a moment to review our legal disclaimer. MGIC is providing this as general information based on current industry guidelines at the time of this recording. It is always advised that you seek the guidance of your own compliance and regulatory departments.
Hello, and welcome to our series on evaluating and calculating borrowers' income. I'm Sandra Sweeney, Senior Customer Trainer and Program Designer for MGIC. This is part 2 to our series on evaluating and calculating borrowers' income, and in this video, we'll discuss how we calculate fixed income. Remember that fixed income is income with a predetermined amount that occurs with regular frequency and has a defined documentable term. Today, we'll cover the importance of validating the borrower's income documentation before you begin calculating their income. I'll explain how crucial it is to determine pay frequency. I'll also give you tips for determining whether your borrower is paid biweekly or semi-monthly. Along the way, we will start to calculate some income. So let's get started. I always say validate before you calculate. So we are going to start by exploring what you need to consider when you are reviewing the loan application, as well as income verification such as pay stubs, W-2s, and verification of employment. This step ensures that your documentation is complete and does not include any discrepancies that would require explanation or any red flags that might indicate any omissions or misrepresentation. The sooner you can complete the validation process, the better your communication with your borrower will be. It will be frustrating to your borrower if you have been provided documentation and wait until weeks go by before you start questioning or requesting explanations and/or documentation. Let's first look at some basic documentation requirements. Your review of the borrower's income will start with the loan application because this is what tells your borrower's story. You should make sure that the employment section of the 1003 is complete and includes the borrower's employer's name, address, and phone number. The borrower's position needs to be provided along with the start date for each employment. A complete 2-year history of employment is required. You will want to question names of employers that might suggest that the borrower is either self-employed or works for a family company. Employment gaps should be questioned, and if significant, a letter of employment should be obtained. General income documentation requirements include the following. Documents must be computer generated or typed. Handwritten pay stubs or W-2s are generally going to have to be replaced with either a verification of employment or, in the case of a W-2, an IRS transcript may be used. The name of the employer as well as the employee should be clearly identified. Any documentation should be complete, not cut off on either sides, and legible. All documentation must originate from a third party and should not contain any alterations, erasures, or corrections. Let's take a look at a pay stub and discuss what are the minimum requirements and what we should be looking for upon review. The employer must be identified and should match the loan application. The borrower should be ID'd either by name or Social Security number. The pay rate should be included, identifying the borrower's wage or salary. Pay frequency should be determined by the number of hours or period ending date. The year-to-date earnings shows how much they have earned year-to-date for each type of income as well as the total year-to-date earnings. Pay stub should reflect deductions such as Medicare, federal taxes, state taxes, and Social Security. It should be noted that 9 states do not require state income tax. They include Alabama, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington State, and Wyoming. Let's go over this pay stub to determine if we have everything that is required. We note that we have the employer listed as WebVision Incorporated, along with the address. Of course, employers do have many different locations, so the address is not always going to be the same as what is on the 1003. If, however, the employer name is different, then that would necessitate an internet search to see if this is a business doing business in another name. Our borrowers should be identified, and yes, indeed, we have Elizabeth Simon, and the address provided should match the address that is provided on the 1003. Her rate of pay is listed as $2,307.70 per pay period, and we are given a Social Security number. That is not always going to be included. However, if it is on the pay stub, you can cross-reference it with other documentation in the file. We do have her pay frequency listed right on the pay stub as bi-weekly. We also have the check date and the period ending date. We are shown her hours as 75 hours per this pay period with an earnings of $2,307.70. And her year-to-date earnings are provided as well. Deductions are noted. If they were not, we would have to question if Elizabeth Simon was truly a salaried employee or perhaps a 1099 independent contractor. Of course, it doesn't stop there. Let's look at some W-2s. First, we will start by confirming that we are looking at our borrower's W-2. Elizabeth Simon and the address provided should match what was given on the loan application for her current residence. The employer name should match. The borrower's Social Security number should match all other documentation present in the file. The employer identification number, or EIN, is a 9-digit federal employee ID number that can be authenticated. When it comes to the dollar signs, box number 1 will reflect the borrower's taxable wages. Box number 3 will reflect the Social Security wages and is maxed out per year. The maximum Social Security wages for 2022 equals $147,000. For 2021, it equals $142,800. And for 2020, it equals $137,700. Box number 4 should reflect 6.2% of the total Social Security wages. Box number 5 is the Medicare wages, which will equal your borrower's total gross wages. Box number 6 should reflect 1.45 of total Medicare wages. Sometimes a verification of employment may be provided or may need to be requested. The lender may use the request for verification of employment. This form will be completed by the borrower's employer. The form should be completed in its entirety. However, it should be noted that fields 11, 14, 16, 17, 18, 19, and 24 are optional. In this section, we will discuss the importance of determining the borrower's correct pay frequency. Borrowers are paid in many different ways, and pay stubs come in many different formats. So we need to take the time to review the pay stubs carefully to determine how often the borrower is paid. The first step in income calculation is to determine the pay frequency. Is the borrower paid hourly, weekly, bi-weekly, semi-monthly, monthly, or is their income based on an annual salary? Once pay frequency is determined, we will know what formula we should use. One area where mistakes are seen often is the confusion as to whether the borrower is paid on a bi-weekly or semi-monthly basis. Let me give you an example of why making the correct determination is crucial. Let's say that you see that your borrower is paid $3,000 per pay period. You think that they are paid on a biweekly basis, so you make the following calculation. 3,000 times 26 divided by 12 equals 6,500. When in fact, they are paid on a semi-monthly basis, and the correct calculation should have been 3,000 times 24 divided by 12 equals 6,000. This is a $500 difference in qualifying income, and this could very well be a material error. What I mean by that is if you had used the correct amount for qualifying income, your borrower's debt-to-income ratio may have exceeded the guidelines, and your borrower may not have qualified for the loan. This could result in a buyback request by your investor. How can we avoid making this error? Let me give you some tips. If a borrower is paid on a semi-monthly basis, there will be 2 pay periods in a month. The first pay stub should go through the middle of the month and the second at the end of the month. The pay stub schedule will typically be the 1st and the 15th, or the 15th and the last day of the month. If hours worked are reflected on the pay stub, you may see some odd hours, such as 86.67 hours. If you calculate the year-to-date average and the previous year's average, and they do not support the income that you have calculated, believing that the borrower is paid on a biweekly basis, you will need to re-review the pay stubs, as the borrower is most likely paid on a semi-monthly basis. Okay, time to calculate some income. In this section, we will give you an example of base income calculation for a borrower that is paid on a bi-weekly basis. As we previously validated Elizabeth Simon's income verification, we can now start our income calculation. We are going to start by making 2 calculations. First, we will calculate the borrower's qualifying monthly income. Secondly, we will then calculate the year-to-date average for this job. Looking at her pay stub, you might wonder why the hours are reflected as 75. This is because not all of our borrowers will work a 40-hour work week. The important criteria for fixed income is that the hours reflected on the pay stub are the same for each pay period. In Elizabeth Simon's case, she is paid on a bi-weekly basis for a 37.5-hour work week. You might also wonder if you should include the flex dollars. My question would be, do you know what these are? And if you don't know what they are, then how do you know if they are going to continue into the future? So, without additional clarification from the employer, we will not be using the flex dollars. What date are we going to be using to calculate income? The check date or the period ending date? We will use the period ending date. Elizabeth's monthly qualified income would be calculated as 2,308 times 26 divided by 12 equals 5,001. Her year-to-date average would have been calculated as 27,692 divided by 5.63 equals 4,919. Where did the 5.63 come from? This is the period decimal calculation, which is the days in the period divided by the days in the month. For this example, it would be 19 divided by 30 equals 0.63. So we have all of May and 0.63 of June. We are not done because we're also asked to review her W-2s. Which box are we going to use? Box number 1, which is the taxable income, or box number 5, which is the gross income? We will be using box number 5 and using gross income of $57,400 for the year 2021. For 2020, we will add in gross income of $55,200. What does our simple worksheet look like now? Here you can see that we have steadily increasing income. which would be a result of cost of living increases along the way. We would have no problem at all using our calculated income of $5,001 per month. In this section, for our next base income calculation example, we will be looking at a borrower who is paid on a semi-monthly basis. For this calculation, I would like to introduce you to an income calculation tool, our MGIC Employment and Other Income Analysis Worksheet. This worksheet can be found at mgic.com/SEB. It is housed with all of our other worksheets, and as you can see, it is indicated as our Income Analysis Worksheet. This is what it looks like, and I'd like to show it to you live. Once you download the worksheet, you will see this is what it looks like. It has several areas where you can capture the borrower's income. And if you need to open up a section, you would simply click on this radio button, and then you will be ready to calculate some income. Scrolling down, there is sections on the bottom to help you gross up non-taxable income. Then there is also a section where you can add comments or notes to help others who come behind you understand how you have calculated the income. Okay, taking a look at our borrower's verification of employment, we see that we have our borrower, Sam Semi, who has worked as a lab tech for his current employer since February the 6th, 2021. His current gross pay is indicated as $1,854, and his rate of pay of frequency is indicated as semi-monthly. In 2021, when there wasn't a complete year, the income is shown as $38,495. In 2022, for the full year, the income is $44,506. Year to date, as of January the 5th, 2023, the income is $598. Let's see what this looks like in the MGIC worksheet. Our worksheet has helped to calculate the monthly qualifying income for you. A review of the year-to-date average as well as the previous year's income shows that the calculated income has been supported by previous earning trends. Therefore, we would have no problem at all using the income as calculated at $3,708 per month. Questions to ask. Does the employment and income information match what's on the loan application? Does the year-to-date average support the qualifying income? Does the information satisfy the intent of the guideline? If not, what information can the borrower provide? Take a moment to check your understanding. Do you know how these two statements should be completed? Let's go over them together. Income is generally considered fixed if it is received at a regular frequency and is for a predetermined amount. If the borrower's pay stubs show 86.67 hours in a pay period, this is a clue that the income is received on a semi-monthly basis. Remember, qualifying income must be reasonable, verifiable, consistent, stable, and likely to continue.
Thank you for joining us for Magic Minutes. We hope this brief tutorial has made a difference for you. For more how-to videos, visit mgic.com/training.